Hi there, and welcome to this first lecture for Banking Risk 2 on interest rate risk, term structure and the sources. The learned outcomes for this lecture is we're going to start with exploring why the banks, the intermediaries, are important in a capitalist society when it comes to the creation of wealth. We're going to look at why interest rate risk is important in the context of financial institutions. As part of this, we're going to explore why the likes of interest rates change and the theories behind why the yield curve and term structure changes. And then we will end by explaining the various regulatory definitions of the sources of interest rate risk within the financial institutions. So let's start by explaining why the banks are important in a capitalist society. And the first thing to note is, in a capitalist society, the banks and the intermediary sector are the ones that create the wealth. For countries to become more prosperous, the idea is that the government needs to ensure that the population feel wealthy and that over time the country and the economy grows, and in a capitalist society, the role of the financial system is seen as a way of wealth generation. And that's what we'll start by explaining in this part 1. Let's look at this diagram. The concept of the financial system in the first place. We have people that have money, we have savers, and then we have deficit borrowers. How do we get money from people who have money to people who require money? Well, you can do the likes of direct financing. Nowadays that would be via crowdfunding. But traditionally, going straight from lender to saver is very inefficient, a lot of risk there, and potentially less regulated. You can go via the financial markets, the likes of the capital market and the money market. If you go via this route, it's regarding the transaction of a financial security. So borrowers would issue the likes of equity or debt, and lenders, savers would buy these securities. So it's about purchasing and selling of financial securities. However, the third route and the most common route for getting money from a surplus holder to a deficit holder is via the financial intermediaries, via the banking sector. And growing up in a capitalist society, you know that if you want to get a loan, you go to your bank. If you have excess savings, where do you put it? You put it in the bank. And it's this process where wealth is generated, and we'll explain this. But where do the regulators and supervisors sit in this diagram? Now, as you can see, the financial system is regulated by the likes of a prudential regulator, who covers safe and soundness, but also the conduct authority, who regulates the conduct of individuals within the financial system. So regulators focus on the financial intermediaries themselves and the financial markets. But think about the role of the regulator. Who are the regulators there to serve? Are they there to serve the consumer? Traditionally, the conduct authority, that is their role, to protect the consumer. But the prudential regulator, who's regulating the safe and soundness of the financial system, their mandate is really set from a government point of view. If governments in a capitalist society want their country to be more prosperous and wealthy, ultimately they want to avoid any sort of financial crises and any downturn in the economy. Thus, a prudential regulator has to ensure the safe and soundness of the banking system. And what we've seen over recent history is the kind of conflict here. Governments want the banking sector to generate wealth, but at the same time, they don't want the financial system to get out of control and cause economic damage to the economy. So it is the role of the financial system to generate wealth, but as we've seen, it can also destruct wealth if it's not done in an appropriate manner. If we recap that the purpose of the financial system is really to allocate resources efficiently, now we're talking about financial resources, then the role of the financial intermediary is seen as the most efficient way of getting finance from people who have it savers and to people who demand it. Who are these borrowers and savers? Well, savers can be anyone. They can be householders, firms with surplus profits. They can be governments that run a surplus budget. On the flip side, who are the borrowers? Again, it's the same people. It would be traditionally governments that run a deficit, and as you'd be aware, in most capitalist societies at the minute, governments do run a deficit, and follow the COVID crisis, a quite extensive one. So really now it's more important than ever that the financial system is still there to enable wealth creation. And the next few slides are going to explain how the likes of a financial intermediary, specifically a bank, does this wealth creation process and then allocate these resources efficiently. Let's look at a simple balance sheet construction. Now, as you're aware, a balance sheet, on one side it has assets, and on the other side it has liabilities plus ownership equity. Obviously ownership equity if it is a publicly listed organisation. So that's a simple balance sheet. But let's look at that from a banking point of view. Assets, in other words, what you've got, what do you physically have on one side, and on the other side, how do you pay for what you've got? We have to remember what is an asset in the bank. An asset in the bank is loans. Liabilities for a bank are customer deposits. In other words, they use that customer deposit. How do you pay for the loan? You use it by customer deposits. So it's the first key point from a bank's balance sheet point of view is a bank's asset is a consumer's liability. The bank's liability is the consumer's asset. So if you were to put cash into the bank, that's your asset, that's your cash. But that is transformed on the bank's balance sheet into a liability because the bank owes you that money back and it knows that you may take it out if it's a cash deposit. So let's continue with that knowledge in mind. So let's look at the creation of a basic bank. So let's assume we've generated a new bank in Newcastle, and on the first day of operation, first customer deposits £100 into our new bank. There's two ways of looking at this. On the asset side, they can say it's cash in the vault, because we've received £100, we've sticked it in the vault, locked it away. So that's the bank's asset. But how do we put that as the liability? Well, it's somebody else's money. So therefore, it's a checkable deposit. So that £100 is went on both sides. One is the liability, because we, as the bank, owe that back to the customer. But it's also classed as an asset, because it's money, cash sitting in our vault. So that's one way of looking at it. But let's look at a different perspective. We changed the term cash in the vault to reserves. It's our financial reserves. So the second balance sheet here, again, it's still our liability. That £100 is a customer deposit that we have to pay back if the customer wants it. But on the asset side, we call this reserves. Yes, it is still cash in the bank. It is still in our vault. But it is also known as our reserves. And this will become clear on the next slide why you might call it this. Okay, now let's scale this up. We've been quite successful in our first week at attracting additional customers. So now we have 50 customers who have all conveniently provided £100 each. Again, if we look at the top balance sheet, we'll say, again, liabilities, we have to pay it back. £5,000 of liabilities because we owe it back to them. But on the asset side, again, if we put it in the vault, it's cash in the vault. But this is where the wealth creation actually happens. Banks don't just put the cash in the vault. If we look at the second balance sheet, this is what actually happens. What the bank does is, again, liability stays the same at 5,000, But on the asset side, this is where the maturity transformation happens. We put the cash reserves as 500, and then the bank knows that we can potentially lend out a large proportion of this cash reserves, and it converts the 5,000 into 500 cash reserves and 4,500 into potential loans to lend out to customers. So this is the first step in the wealth creation process. How did it transform its asset from being cash in the vault to financial cash reserves and loans? And it's all about the deposit retention ratio. How much money does the bank need to keep as cash reserves in case customers potentially take out their deposit? Because as we know, it is a liability. Now, banks are in a privileged position that there's a track history and they can potentially model how much of the cash will be withdrawn. Therefore, they can keep that in financial reserve in case customers want it back, and then they can lend out the rest in the form of loans to generate potential income from them loans. And in the context of this lecture, the retention ratio where we have potential 500 in reserves, we also call that as liquidity. That this cash is in the vault, this £500, and it is a liquid concept. So if customers want it back, it's there for them to receive. So that's to maintain liquidity. So let's ask ourselves, what are the benefits from this process to the bank? Well, the benefit for the bank is we can now earn an interest on the loan. So that 4,500 can be lent out, and we can charge consumers for this lending. So we can potentially earn an interest on this loan. If we earn interest on a loan, then the idea is to generate profit. How do we generate profit? Well, you think profit generation, if you think from just the interest point of view, on our customer deposit, we may give our customers 1% for depositing with us, but on the loan, we may charge 5%. So that additional 4% would be classed as our profit if it had the same maturity. And this is how, ultimately, the bank is an intermediary. It's transformed our asset into their liability, so it's done that sort of transformation, but it's also potentially transformed the size. So, we had 50 customers putting in £100. That has probably created two loans, one being 2,000, the other being 2,500. So it's transformed by pooling. Loads of small deposits have been transformed into two large loans potentially. But it's also potentially changed the timescales as well, because our customer deposits could be classed as short term, but these two large loans that we've lent out could be long term. So the bank has done a lot of transformation there. But what about the risks? Well, the first one is we have £5,000 of liabilities. What if the customer wants that back? Also, we've just lent out two large loans. What if them customers default? They don't keep up their loan repayments. I notice there the kind of scaling of maturity change from short term to long term. What if there's a mismatch there, and that more short-term customer deposits are wanted back rather than the length of the loan? I mentioned that we give an example of two large loans. What if they're too large? And if one defaults, how will that impact the safe and soundness of the bank? So given this whole transformation process, when we put this in the context of the module, let's look at the questions again. If there's a difference between asset and liabilities when we're talking about profit, then there's an element of interest rate risk there. When we talk about customers and customer deposits on the liability side, well, how much of these customers are going to withdraw their money and when? So we need to have that cash reserve, which is a concept of liquidity risk. We're a bank. What happens if any of these customers are fraudulent? Then that's what's known as operational risk. In your previous banking risk one module, you cover the concept of default and credit risk. When we talk about how long the loans are or how long the liabilities last for, we're talking about maturity, and obviously depending on scale, we're talking about the size of the assets and liabilities. So all of these risks we do discover within this module. And in the concept of credit risk, of course, we recap it. So here we can recap how the bank manages all this transformation. And as I noted before, when it comes to customer deposits, the banks can potentially manage and profile the likelihood of depositors wanting their cash back so they know how much reserves to hold. And here's a question to you. Deposits. If interest rates change, how many people change their bank account or put their savings elsewhere? In general, how many people change bank accounts? In the UK, historically, that's not very often. And the banks in the financial system know this. And technically, customer deposits, even though they're the most liquid form and they could go overnight, the likelihood of that is rather low. Banks know that customer deposits stick. We keep our money in the banks in a capitalist society. As well as this, banks expect cash deposits from customers to grow over time. If customers are becoming more wealthy, if the population's becoming more prosperous because the banks are creating wealth, then at the end of the day, more people are going to have more money. Therefore, customer deposits should grow over time. The accumulation of the wealth creation will be stuck and stay in the bank. Money may just change hands, but ultimately they'll stay within the banking sector anyway. And they also know that loans, typically they can model the likes of default risk and they can work out the potential income and repayments of loans monthly. But lastly, from a UK point of view, and other capitalist societies, the banks hold a privileged position. The central bank, in the UK, the Bank of England, that's the lender of last resort. Banks, for safety point of view, do hold a reserve with the Bank of England, and they do know if they run into trouble, they can go to the likes of the Bank of England as lender of last resort to do a repurchase agreement for additional liquidity. And central banking sector really does help the likes of any capitalist economy in the event of any financial shock. So we've seen during the financial crisis of 08 and 09, but also during the COVID crisis, we've seen the intervention from the central banks in the change of interest rates, as well as the quantitative easing process of generating additional cash to provide the banks to lend out. So the likes of central banks are there in capitalist societies to aid the financial system. How do they do that? They do it via intermediaries and providing them with the cash in order to generate additional wealth. So as the banks are the wealth creators, this does actually lead to some potential problems. The first one has been the concept of too big to fail. And since the financial crisis, there's been a lot of academic research and literature into the concept of too big to fail. And that also expands out too big to regulate, too big to break up. All these kind of concepts are being explored by regulators. Ultimately, they want the banks to generate wealth, but at the same time, they want them to be safe. And how do we do that with regulation? There's also the potential issue of an informal economy. And in most capitalist societies, the informal economy, like cash economy, they don't exist that much. But we have seen challenges to this in the recent history. We have the likes of cash crackdowns in India. Another issue at the moment is certainly the likes of cyber assets and that sort of movement. If that is taken finance away from the intermediaries and the financial system, how is that going to hamper the wealth creation process? So there is some challenges to this going on. But also from a regulation point of view, if the banks have all this power, then the wealth creation and money supply in the economy can be up to the banks. So who are the banks working on behalf? Are they working on behalf of the people that work in the bank? Are they working on behalf of its customers? Are they working on behalf of the whole society in general? Or are they just looking after number one and their own profits? And it's this sort of conduct and behaviour that also needs to be regulated. Because ultimately, if the governments allow in a capitalist society the banking system to create wealth, then that's a lot of potential responsibility for the banking sector to have. And if the banks choose not to issue loans, then that ultimately reduces the money supply and slows down the wealth creation. So in times of crises, banks may become more risk averse and may not have as much liquidity and cash reserves to transform into loans, so they don't lend out as much. As I noted in the previous slide, if this happens, the central bank can do the likes of quantitative easing to provide them additional liquidity in order to lend out, to kind of kickstart this wealth creation process. So again, from a regulatory point of view, the central bank needs to ensure the safe and soundness of the financial system, and also needs to potentially influence the intermediaries' decisions on increasing or decreasing money supply. Ultimately, to create wealth, banks need to keep generating loans. Okay, let's have a look at a transformation example and how a bank generates wealth and ultimately creates £500 out of nothing in this example. And that is the wealth creation process. So look at the top. We have our bank, which has 5,000 in deposits or cash reserves. We have a customer one who wants to buy the house. And then on the right hand side, we have an asset owner. We have someone that has a property, and that property is valued at £500. Now let's move down to the second level. Okay, this customer wants a loan to buy this property. So what the bank does is, in order to create a loan, it needs to increase its customer deposits. But in this example, it's done this by customer one becoming a customer of the bank. So before, the customer didn't have any cash, but now the customer does have cash because the bank, what it did was it created a loan of £500 as an asset, and then it assigned that asset to the customer. So we look at the customer has the liability, it has a £500 loan, but the customer now has an asset, which is cash, because it's the bank has generated or created £500 as a number on the asset side, and it's assigned 500 cash to the customer, but as you know, the customer needs to pay that back, so it's also a liability. So the customer now has 500 cash in his bank account, but also has a loan assigned to him that he has to pay back. So this does seem a bit odd in the fact that the bank has generally just typed £500 extra into its computer and then assigned the cash and the loan to the customer. But if we look at the bottom now, what's really happened here is that the customer buys the property, so the 500 cash goes to the asset owner, but the asset owner potentially is also a customer of the bank, so that 500 cash went from customer one to asset owner, therefore that 500 cash is now deposited with our bank, so our bank went from 5,000 up to 5,500 on the liability side. And if we look at the asset side, you can see we have 5,000 in cash reserves, but a 500 loan, which is currently sat with customer one who'll be paying that back. Take time to look at this diagram and read the red text and the arrows to understand what's gone on. But in layman's terms, ultimately, a customer now has an asset in the form of property. That property has a loan on it, but ultimately the property costs something. And when the customer bought the property, they used the cash from the loan, so the asset owner, instead of having a property, has cash, and then that cash is put back into the banking sector, which is traditional in a capitalist society. You don't sit on large sums of money like that. So ultimately, we've transformed a property of £500 into cash and loans of £500. So from a bank's balance sheet point of view, the bank's balance sheet has gone up from 5,000 to 5,500. So do take some time to understand this process. But at the end of the day, we have to remember all of this transactions, it all stays within the banking sector. That's how we know the banks can create wealth, because it doesn't matter who the customer is or the asset owner is, ultimately the finance, the assets and liabilities stay within the financial system, whether it be it on Newcastle Bank or any other bank. It doesn't leave the financial system. Thus, the generation of wealth, in this example it just happens to be all the same bank, but in real life it doesn't necessarily mean it's the same bank. One bank might lend out to buy a property from someone else. That owner might receive the cash and put it in another bank, but still the cash does not leave the banking system. And just to recap, again using simplified balance sheet, what you can see here, certainly on the liability side, remember that's the funding side, how the banks fund their assets, they mainly have it through customer deposits. What you can see is a breakdown of ways that banks potentially fund their loan and wealth creation. The majority of the time, the idea is that they fund it through customer deposits, which you can see highlighted in red here, whether that be what's known as checkable deposits. These are kind of deposits that is more liquid, that can go in and out constantly on a daily basis. But a large proportion of customer deposits are what's known as sticky, i.e. they're savings accounts, ones that we don't really take out as often. But banks are not as simple as that. The banks also use borrowing, so they lend from the financial markets, the money markets, so they potentially also lend from markets, borrowings, to lend out to customers. And that's where we can see potential lots of liquidity issues. That's what happened in the case of Northern Rock, which we'll cover again in this module. But also bank capital, ownership equity. That's also a large element of the liability side of a balance sheet. And that's really the element that we'll cover a lot in this module. And the impact of interest rate risk, liquidity risk, and operational risk on the balance sheet in general, but ultimately if these risks impact the asset side, then potentially where on the liability side does it impact? It impacts, the likes of deposits and borrowing, but if the asset side shrinks and the balance sheet liability side shrinks, ultimately that must mean that bank capital will also shrink. So we're going to work out the impact of the likes of these risks on the balance sheet, and specifically to capital and regulatory capital. And we'll show you how banks have to manage their regulatory capital in the light of these risks. So as we know from what I've already said and from your previous module, risks can arise from various different locations throughout this whole balance sheet, but the purpose of this module is to understand how the three risks I've highlighted impact the balance sheet and ultimately impact regulatory and banking capital, and how the likes of Basel III have capital requirements in place for these risks. And just to finish off this part, in the concept of this module, when we talk about interest rate risk, liquidity risk and operational risk, we're really referring to the financial assets and financial liabilities. We're not obviously going to explore too much about the other sorts of assets, such as the buildings and computers, but that is also relevant when it comes to the operational risk part within this module, because operational risk does include the likes of issues to the buildings and financial loss from, say the likes of a natural disaster, and how we kind of protect our financial institution from that with the likes of insurance and other operational risk policies. But from this part, we have to remember the privileged position the banking sector are in that they are the wealth creators of a capitalist society, and that the banks can potentially generate wealth but also destruct wealth if they don't do it in a correct manner. And when times are hard, we need to understand how these risks impact the likes of banking capital. And this concludes part 1. Hello, and welcome to the second part of this lecture, where we're going to look at the theories and reasons behind why interest rates change. So, let's start with what is an interest rate. Now, what you'll know from your pre-reading and your pre-modules before this point is that interest rates are simply a price, and this price factors in elements such as inflation, the costs of deferred consumption, and risk. Now, obviously risk, this is a range of different risks. This could be credit risk, liquidity risk, market risk, and so on. We can't really decompose the amount of an interest rate between these concepts. Obviously, we can potentially decompose the amount of inflation, given that the inflation rate is produced in a regular basis from the relevant authority in the country where the interest rate is set. So interest, we can work out what element is inflation, but again, it's not as straightforward or as black and white as that. When we talk about the cost of deferred consumption, this is, if we talk about the likes of savers, they want to be rewarded with an interest rate for not purchasing now or using their wealth to purchase anything now to generate their own utility, happiness. So if you want to defer any consumption, you want to be rewarded for that. And if you defer your consumption because of inflation, you know your consumption may be more expensive in the future, therefore you want to be compensated with a rate above inflation, but also that involves compensation for deferring your ability to spend now. So let's look at what make interest rates change, or what determine an interest rate. Let's talk about the risk structure of interest rate. So we've mentioned that it is obviously to compensate for inflation and deferred consumption and risk. But what is this risk? Well, as I've said before, it could be a combination. Predominantly, when we look at interest rates, we kind of look at the likes of default. The higher the credit rating, the lower the interest rate. If you're more likely to default, then the interest rate you're charged on the loan will be more. When we talk about government debt, we assume that it's risk-free. But is it? In history we've seen the likes of some sovereign nations defaulting. Argentina, as an example. But if we look at the likes of the US, you can have a click on this article, and we've seen a number of what's known as government shutdowns in the US, where the government can't agree on a new budget or increasing the debt ceiling. And if they can't increase the debt ceiling in the budget, then the government can't borrow. And if the government can't borrow, they might need this borrowing to pay off pre-existing debts, which is very common in the US. As you'll know, the US have a deficit budget, and they heavily rely on short-term borrowings T-bills from the money markets, and it's seen as a very revolving sort of debt scenario in America. They borrow debt to pay off previous debt and so on at a short term, unlike the UK, which tends to be more long term. So if the US government can't agree to increase the debt ceiling, then the shutdowns occur. And when shutdowns occur, and if this persists, then the increase of default actually slowly increases. So we say government debt is risk-free because they have the ability to tax their population. However, is it 100% risk-free, given these examples? And nowadays, with the amount of borrowing from the COVID crisis, we've seen budget deficits in many Western countries increase dramatically over the space of a year. And how is that level of debt going to be managed moving forward to be reduced? So let's look at the risk structure in a bit more detail. If we have default risk or lower the credit rating, we'd expect the yield or the interest charge to be greater, to go up. If you're going to buy a product, a debt product from an organisation with a lower credit rating, you want to be compensated more for the level of risk you're taking. The likelihood of default, therefore, you want to be compensated for this. Liquidity. If liquidity increases, so you have a liquid product, then the interest on that would be lower. Because if it's liquid and you get it back quicker, then you don't need to be compensated as much in the return. If there's an increase in information costs, the costs of actually getting information about the product, access to potentially transacting the product, any sort of information transaction costs, if they're increased and not very efficient, then you want to be compensated more and a higher interest rate is charged. And of course, depending on the country, if there's an increased amount of taxation on any sort of interest product, then of course you want to be compensated with a higher rate if your tax liability is also increased. In part 3 of this lecture, we're going to talk about term structure of interest rates. And what we're referring to there is what's known as the yield curve. And the yield curve is where the x-axis is time and the y-axis is interest rate. And we plot interest rates at various time horizons to look at the shape of the yield curve. And we believe this yield curve to be forward-looking because the yield curve plots interest rates from overnight up to 50 years perpetual. We can suggest what the interest rate in 50 years time might be by looking at the yield curve, as it shows the relationship between maturity and interest rates. And this yield curve is what we're going to explore in your first seminar, and whether it is actually forward-looking. But later on in part 3 we'll explain the theories behind the shape. But first, let's look at interest rate risk in general from a business point of view and why interest rates change in the marketplace. So if you think in the real world, think about a business. Why would interest rates change at a business level? Well, interest rate risk arises from the availability of cash. If there's a low amount of cash in the economy, then supply and demand will determine how much interest rate is charged on that supply. From a business point of view, you borrow money to invest. Invest in the likes of your business, new machinery to make your business more efficient. If there's less opportunity for investments, for instance, if there's new technology out there, you have to weigh up the concept of, is it worth investing in that new technology to make my business better? Is it worth taking out the loan for the potential reward of being more efficient? If that's no, then you'd continue as normal and you wouldn't borrow. And if you don't borrow, that lowers demand for borrowing, so there's no need for interest rates to increase if no one's looking for positive investments. So we can look at it from that point of view. But let's also look at the example here. If a company takes out a loan which is on a floating basis, in other words, it rises and lowers depending on base rates, if interest rates in the market increase, then that may hamper the organisation's ability to make profit from the investment they made from the loan, potentially could lead them into financial problems. And then if they can't actually take advantage of additional lending in the future, then they potentially can't roll over this loan because they don't have the money to pay back at a higher rate. Then the company could result in having a refinancing risk. In other words, they can't roll over the loan or can't borrow further in the future because interest rates have gone up. So there's lots of implications of interest rate changes on a business. Now let's look at why in the market interest rates change. So in the next few slides, we're going to look at the likes of monetary policy. One of the big indicators of why interest rates change in a capitalist society is monetary policy from the likes of central banks. We're going to look at the concept of money market approaches, and this is the concept of demands for cash. If people demand more cash, and cash is fixed, then interest rates would go up. We're going to look at loanable funds theory and the concept of interest rates change depending on the demand for loans. A big driver in capitalist societies of interest rate changes is the amount of government borrowing. If government borrowing increases, then their borrowing, which may hamper the amount of supply of cash available because it's tied up in government borrowings, this could actually push up interest rates in general. And there's other factors such as economic conditions, global pandemics, financial crises, and geopolitics, some of which we will not cover in this lecture, but of course you can do your own reading on the impacts of geopolitics on interest rate setting and changes. But first, let's look at monetary policy. In monetary policy, we'll use the UK as the example here. Monetary policy is surrounding the level of inflation. Governments in many countries have an inflation target. In the UK, the inflation target is 2%, and this is seen as suitable. If inflation is 2%, then there's sustained growth, and if things are becoming more expensive gradually, then ultimately that's actually a sign of wealth creation, wealth generation. You don't want inflation to be too high, but you also don't want it to be too low or negative. You want a nice bit of growth there to highlight the wealth creation process, everyone feeling wealthier by 2% each year. And the role of the central bank is to try and maintain this level of inflation, and in order to do that, they adjust interest rates accordingly. If inflation is very high, how do you control that? This means prices are going up. Therefore, what you can do is you can start to increase interest rates. If you increase interest rates, then people potentially save more and don't buy. It also pushes up the price of borrowing, so people can't borrow as much, therefore they don't borrow. And if people are not borrowing, they don't have money to demand. And ultimately, if people are saving, they can't borrow for demand. This lowers the amount of demand in the economy, and if demand in the economy lowers, then ultimately inflation will start dropping. On the flip side, if inflation is low, then you could start decreasing interest rates. If you decrease interest rates, then people will not save as much because they're not getting a return on their savings. And then people will borrow more because borrowing is cheaper. So people are not saving as much and they're borrowing more, then they're going to be spending more. And this is going to drive demand in the economy, which the idea will it'll push up inflation. So this is kind of one easy example of how interest rate setting impacts inflation. But obviously it's not as simple as that. Additionally, the likes of interest rate setting and inflation does impact the integrity and value of the currency in that country. So central banks also need to maintain the level of integrity and the value of its currency. One of the first steps of maintaining the integrity of a currency is ensuring that inflation doesn't get out of control. Ultimately, when you're in an example of hyperinflation, like we've seen in the past with Yugoslavian Republic, Zimbabwe, Venezuela, if inflation is too high, then the integrity and the value of the currency collapses, and no one trusts or has confidence in the currency. And if no one has confidence in the currency, then this does lead to large-scale economic problems and really lowers demand in the economy because no one has the actual fiat currency to use to buy expensive goods. So monetary policy obviously is to look at the level of inflation, but also it's used to stabilise the currency in the process. And if this is achieved, and in the UK, recent history has shown us that inflation doesn't deviate too much from around this 2%. It's never really been 2%. It's always been, well, up to 4, 5, down to 1. It's always around this area, but we've never seen examples of really high inflation and loss of confidence in our economy or currency. And if central banks achieve this, then it gives business a bit more certainty on how to price goods and more trust in the currency they're using. But also, with this sort of monetary policy and upholding the integrity of a currency, this also helps for future planning and when we look to price future goods, potentially in the derivatives market. If we had to plot this on a graph, when we talk about the demand for money, so money market demands, we assume that money supply, cash, is fixed. And that's a straight line. So we assume the supply is fixed. Obviously, you could argue that during the monetary policy process, you only talk about interest rate setting. But when interest rates are low, which we've seen at the current time, how else do you supply additional wealth to the banking sector for them to lend out to kickstart the economy? You do that by quantitative easing. The central government can print money. How can it print money? It prints money which shifts the money supply to the right through quantitative easing. It prints this money, it lends it or gives it to the banking sector in return for debt, bond debt, which increases the amount of money supply that intermediaries have to lend out. So if money supply increases and demand in the economy stays the same, then this would ultimately also lower interest rates. If money supply is increased, and then because money supply is increased, interest rates are lower, this hopefully would push up demand. Then if demand in the economy starts increasing again, then hopefully that will start to increase interest rates moving forward. But remember, this example is the demand for cash. There's also other elements in this diagram that we don't take into account. Say in normal times, if an economy is becoming wealthier, the wealth creation is working, then the idea is that customer deposits will grow over time, which we mentioned in part 1. And if wealth's increasing in the economy, but money supply of cash is fixed, then that will also push up interest rates, because if we become wealthier, we demand more cash, naturally, because we hold more cash. Therefore, that will also push up interest rates, because we demand more cash to store our wealth that we've generated. If we don't move money supply, then of course interest rates will also go up. Let's look at another concept. Instead of thinking about the demand for cash, we'll talk about demand for loans. And you can read this up in loanable funds theory. But the concept's quite simple. Supply is not fixed, demand is not fixed. In this example, the supply of loans depends on the level of wealth that banks have to lend out, and the demand for loans depends on profitable investments. If there's more opportunity for companies to make profit from any sort of investment, like I said, into machinery, then they're going to demand more funds. They're going to demand more loans to invest in these profitable investments. But if interest rates are very high, then the opportunity for profitable investments decreases. So let's again look at this on a diagram. So in this case, as I mentioned before, the supply of loans is not fixed this time. So where does this supply come from? Well, it comes from the banking sector, of course. And obviously, this is where the banks can control this, because they can control supply of loans dependent on interest rates. If interest rates are really low, does the bank really want to give out loans at low interest rates when that's not as profitable? They'd like to give out loans when interest rates are high. However, who's going to be taking high interest rate loans? So that's where banks need to kind of get the equilibrium here to match, obviously, the level of demand at a given interest rate. If we again plot this on the graphs, if interest rates increase, supply will increase. As I've said, banks will want to make more profit from higher interest rates, but ultimately the demand for loans will go down. No business wants to get a loan at high interest rates because they'll have to pay more money back, and whatever they borrowed for in the first place might not actually be as profitable or efficient if the loan was too much. If interest rates drop, then you could say supply would drop, but really supply more likely is going to stay about the same, because ultimately the banks still need to make profit somehow. But demand will of course go up. If interest rates drop, then demand for loans will go up because funding is cheaper. And if you go back to the example I gave before in the monetary policy point of view, the concept of lowering interest rates is to increase demand in the economy to get inflation back up again. So you can see how the likes of monetary policy and loanable funds theory have a linkage there. If we compare the two, the likes of the money market approach, the demand and supply of cash, obviously cash is more short term, it's more liquid, whereas the money market approach really looks at interest rates from a point of the amount of cash that they hold. However, on the flip side, the loanable funds theory really looks at the price of interest rate from an earnings potential and a wealth creation potential. So the decision on interest rate change of a money market depends on the level of cash, but the interest rate change on the loanable funds theory really is determined by more profitability reasons, not the level of cash. And if we finish this part by looking at the various other reasons, except from theoretical reasons, why interest rates in a market would change, well, we've already mentioned the degree of risk. And that's obviously depending purely on who issues whatever the product is. It also depends on the length of the product and, what type of product does it have. If it's a product that has certain levels of collateral, then you probably want to be compensated less because at default, you can have some sort of collateral behind it. So it only depends on, who issues the product and what the product is. I mentioned there timescales, and that's kind of about liquidity. But if we think about it, if you're borrowing for 30 years, what's going to happen in 30 years' time? A lot can happen between now and 30 years. A lot's happened in the last 2 years that no one would have ever predicted. We certainly wouldn't have predicted 30 years ago. So we need so interest rates change. Again, it is determined on timescales and on products. Think about economies of scale. It's cheaper to write one large loan than it is to write 10 small loans. So interest rates may change on products depending on economies of scale as well. But as we've just covered at the higher level of why interest rates changed, we've talked about monetary policy briefly there, but I'd also highly recommend that you get out the textbooks and you recover this. So if we look at the likes of Keynes's liquidity preference theory, which is the more money market approach, which is focused on the supply and demand of cash, of why interest rates change. So that's the money market approach. But then when we talk about loanable funds, have a look at Fisher's classical approach, which then turns into the loanable funds theory. When we talk about the likes of government borrowing, if it's on a large scale and we have large deficits, then if governments are the biggest demander of funds, then potentially if they borrow a lot, then that's really going to hamper the amount of loans or supply available, which if that really contracts the level of supply left from loans, then that's going to put up interest rates in general. And as I mentioned, other economic shocks, factors, human capital, financial crises, global pandemics. So there's a whole host of reasons why interest rates may change at a high level, but also at a product level. And this concludes part 2 of this lecture. In the next part, we're going to look at the term structure theories of the yield curve and interest rate from a banking book perspective and the sources. Hi there, and welcome to this final part of the lecture on interest rate risk and term structure. In this part, we're going to cover the concept of the yield curve, the shapes of the yield curve theory, and then finish off by discussing interest rate risk on the banking book and the sources of interest rate risk to the banks. So to recap elements you may have covered in your previous studies, the yield curve is a simple concept of how you plot out interest rates over time. So the x-axis is maturity time horizon, the y-axis is interest rate. And in normal economic conditions, we'd expect this to be upward sloping. It's more expensive for longer products than it is for shorter products. And we'll cover the various theories for this. But there's lots of elements built into the yield curve that we'll also explore. The traditional shapes are upward sloping in normal times. The likes of flat, this is a concept if there was no inflation. Therefore, longer term interest rates would be the same as short interest rates because the time value of money does not exist. Therefore, you don't need to be compensated for a higher rate. There's also humped and inverted. Typically, a yield curve would become more humped. So it'd start upward sloping, start to become humped if you expected interest rates in the long term to drop. And then eventually it would flip to full inverted where interest rates are being dropped, and then you'd expect further interest rate drops in the future. And typically, these are an indicator of economic conditions. Typically, in a growth stage, you're at normal. When the economy starts slowing down, you become more flat and humped. And then in recessions, interest rates start to invert. The question is it a leading indicator or a lagging indicator? Well, we're going to explore this in your seminar when we discuss the predictability powers of the yield curve. Typically, you can start seeing potential economic issues when you start becoming from normal to humped, and therefore this could signal a recession's on its way. And then when the yield curve starts reversing and you get more of a flat and humped from inverted, then you might think we're in a growth stage. So it's quite difficult to determine whether this is a leading or lagging indicator of economic conditions. But also, these 2D diagrams really don't reflect what actually happens. If we go to Bloomberg and look at the 3D chart of yield curves throughout time, you'll see that the patterns are very different. You may get an S shape depending on short-term money market liquidity issues at the short term compared to longer dated bonds. There's also potential gaps in the yield curve, so at certain times to maturity, some bonds may not get issued, therefore these lines could have gaps in them. So there's a range of different shapes yield curves that you may see, and you'll have to potentially interpret why it looks like this. But from a theoretical point of view, these are the traditional shapes that you may see. It's rather difficult to decompose this yield curve to work out the overall level of interest rate risk. Within the yield curve, what we can see is the concept of the yield curve at the top, and it incorporates all these elements. We have the nominal rate at the bottom, and this is the likes of the Bank of England base rate. This is what's set by the Monetary Policy Committee of whatever country you're in. Then the next level is expected inflation. Again, we can use the 2% target for that. So at least the first two elements of this we can understand. But then, when we build in liquidity premium and risk premium, it becomes a little bit more difficult. The concept of liquidity premium is that if you're investing in debt products, the longer your product is locked away for, the more liquidity premium or return or reward you want for being locked or tied in is greater. And that's also the concept that bondholders are naturally risk averse. When we talk about risk premium at the top there, then this can be many factors. It could be credit risk, could be market risk, could be operational risk. Again, there's plenty of factors in there. Typically, it would be the element of credit risk would top it off there. But ultimately, from the equation at the top, adding all these points in, it'd be very difficult to decompose individual rates at different times to maturity to work out what element is risk, what element is liquidity. Okay, normal rate, we can work that out, but again, expected inflation could be subjective. In practice, before we move on to the theory, take a look at this diagram. Pause the video and potentially research what is the VIX index and the potential moving average of the 3-month to 30-year yield curve slope in basis point. So try and work out what they are first before looking at the diagram. But it's interesting to see from Bloomberg the plot, and it's a plot of how volatility, VIX, on the x-axis moves relative to the movement in yield curve from 3-month to 30 years in the context of the US. So if we look at during the financial crisis, obviously bear in mind interest rates were probably about 5% base rate, quite a normal yield curve until the financial crisis hit. The VIX index is a measure of volatility. So what you can see, the 2-year moving average of volatility during 2007, 2008, 2009, the VIX moves quite a lot to the right, i.e. highly increased volatility, until it got to a point where it was a bit more stable, but then as the financial crisis deepened, interest rates were dropped. So when interest rates were dropped, the moving average of the yield curve slope between 3-month and 30-year, because the yield curve went from being upward sloping to flat and then inverted, you can see the movement upwards in the y-axis here. You can see how the flipping of the yield curve resulted in the 2-year moving average for the yield curve spiked. But then what you can see as time went on, we got to a recovery phase. The yield curve's kind of inverted now, expecting interest rates to drop. During the recovery stage, obviously volatility in the VIX index started to recede, and then because the recovery was quite long, quite slow, when interest rates in America started to increase, they only did it gradually. So unlike the massive spike here when interest rates have dropped, so the moving average shifted quite a lot, it's a more gradual and slow process. Until really we got to 2018 and 2019, we nearly got back down to normal market conditions. Interest rates were slowly rising, so we kind of got down towards where we started. It'd be interesting to see, pulling up this diagram in the future produced by Bloomberg, if this kind of cycle between the volatility in the VIX index and the movement in yield curve, it'd be interesting to see if we got another example. Because what happened during the COVID crisis? Volatility in the markets spiked, which would be a big shift along here. Then interest rates were dropped again, some things around the world. Obviously not from 5% to 0.5%, but from say 2% to nearly nothing, we might still see a similar cycle like this between the yield curve and the VIX index. Do go on Bloomberg, do try and understand what this VIX index is, and then kind of see if you can find a similar diagram of this which we can plot following the COVID crisis. But that's in the real world. In the next few slides, we're going to cover the more theoretical concept of why the shape of the yield curve is the way it is. What theories explain the shape of the yield curve? And you may have covered this before in some of your pre-studies. Or if you're here with us last year, you would have plenty done this in finance, financial markets and institutions. We have expectation theory, liquidity preference theory, preferred habitat, and market segregation theory. And we'll go through each in turn with a mathematical example of expectation theory. So, what is expectation theory? Well, it's the expectation that future interest rates follow the path of short-term interest rates. So, if it's upward sloping, it's because we believe that interest rates are going to increase in the future, therefore it should be upward sloping. Therefore, we expect short-term rates to lead on to long-term rates. If we expect a recession, then we expect interest rates to drop. Therefore, longer-term rates will be lower than shorter-term rates. If this assumption holds true, then without any arbitrage, we would assume that 3 successive one-year bonds would be the same return as just holding one 3-year bond. So if the yield curve slopes upwards, where longer-term rates follow short-term rates, then if you buy a bond for 1 year and it's the same, roll it on the next year, the same, roll on the next year, the same, the investor should get the exact same return back than they would have if they just bought one 3-year bond and held it for the 3 years. And we're going to show you a mathematical example to highlight this. At the start of any given day, the investor has the choice of do they buy a bond 1 year from Roses PLC at 8%, or do they go to Quality Street PLC and do they buy a bond that is a 2-year bond which pays a return of 8.995 or a 3-year bond at 9.5. It's entirely up to the investor which they prefer. But I'm going to show you using expectation theory. It doesn't actually matter which one of the 3 bonds you buy here, because ultimately they yield the same return. If we were to plot them on a graph, it would look like this. So there you have your 1-year bond paying that rate, your 2-year bond paying that rate, your 3-year bond paying that rate, plot out a line, and this is the sort of curve you're going to see. We expect longer term rates to follow short term rates. But we have to remember that this is if the assumption holds true, that there's no arbitrage and all else being equal. So let's assume that the market for Rose's 1-year bond is 8%, and in 12 months' time, we expect the 1-year bond rate for an equivalent rollover, so another bond in 1 year's time, we expect interest rates to increase over that 1 year to 10%, in other words a 2% increase, but we still assume the assumption that one 3-year bond is the equivalent to 3 1-year bonds that roll over. So we have to assume that these bonds are substitutable for one another, but they should pay out the same rate. So let's have a look at a mathematical example. For this example, we're going to look at the concept over 2 years rather than buying 3 years, but the maths is the same if you roll it out for another year. So over a 2-year period, you have the choice. What do? Do you buy 1-year bond at 8%, then after the year you roll it over with the new bond because you expect interest rates to go up to 10%. So in the first year you have an 8% bond, the second year you have a 10% bond. Or do you buy the Quality Street PLC 2-year bond? And if you remember, this 2-year bond interest rate was 8.995%. Assuming that both companies have the same level of risk and so on and all else being equal, that's your choice. Which one do you pick? If expectation theory holds, it doesn't really matter. So let's have a look at the maths. So we'll look at option A and we'll look at the roses where you buy one bond, hold it, and then we crystallise it at the end of the first year and invest exactly the same into the bond at 10% next year. Obviously do remember that bonds pay simple interest. So if we do the maths, in the first year your bond you'll receive 1,080 back. Then you invest that new amount of 1,080 at the 10% bond. So at the end of year 2, you'll get £1,188 back. So that's option A. So for option B, if expectation holds true, all else being equal, then the 2-year bond that you invest in with Quality Street PLC should pay the same. So let's do the maths backwards. At the end of the 2 years, you know you're going to get the 1,188 with the 1-year bond rolled over. So if we put that mathematically, then we have this formula here, which is just trying to work out what would our 2-year bond be priced at to give us exactly the same money that we received if we did the 2 bonds in a row. So we have our initial investment of £1,000. We have the amount we expect to return in 2 years' time. So we end up with a formula of trying to work out what is x in the equation on the bottom. Simple bit of maths from high school here. We can look at the square root of 1188 divided by 1,000, and lo and behold, if you do the maths, it works out that the 2-year bond to give the equivalent return is 8.995, and if you go back to a few slides ago, that's exactly what we said the 2-year price would be for the 2-year bond for Quality Street. If we were to do the 3-year example, it would be exactly the same. Instead of square root, obviously you would have to do the cube root, and the cube root would be the 3-year return of 3 bonds rolled over divided by 1,000. And that, if you do the maths, practice it yourself, it will be 9.5%. So just to recap there, expectation theory is the assumption that future interest rates follow short-term interest rate paths and that bonds are substitutable, and if all holds true, it doesn't matter if you buy 1-year bond and roll it over every year at the new expected rate, or if you just buy 1 bond with the length of the maturity that you're trying to calculate in the first place. So when we look at the predictable power of the likes of the yield curve, assuming expectation holds true, then when we look to the futures market or the derivatives market, the pricing of future interest rate products, what do we look at? Well, we probably look at the yield curve of it. Well, if the 3-year maturity of a bond is this, then if we're going to issue a product in 3 years' time, we should really set this rate, if this holds true. So that's expectation theory. Liquidity preference. Well, this again is a bit more behavioural when it comes to the investor. Now, think about the debt market. We're talking about yield curves, we're talking about debt. Who are the investors in debt products? Bondholders are naturally risk-averse individuals. Therefore, if they want to be locked in to any sort of product, then they want to be compensated for that. We give the example in the earlier section, a 30-year bond. 30 years is a long time. We don't know what's going to happen in 30 years' time. Thus, the longer you hold something for, or the longer you defer your consumption for, you want to be compensated for that. So that's why liquidity preference is more upward sloping. Next, we have preferred habitat theory. As the picture demonstrates, everyone has their natural environment. This is the same with investors. As an investor, if your preferred habitat is short-term debt, then in that habitat you expect certain characteristics. If you're an investor and prefer to invest in longer term debt, again, you'll have different requirements. This actually contradicts expectation theory because it suggests that along the yield curve there's different investor types and different preferences. Therefore, it doesn't matter about expectation theory because people at a longer time horizon expect very different things to investors over short time horizons. So this is a very behavioural concept. And also what it suggests is if you're an investor short term and you want, as the borrower, to convince short term borrowers to borrow over a longer term, you're wanting them to go outside of their habitat. How do you encourage investors that are naturally risk averse to take on additional risk and lock in for longer? Of course, liquidity preference theory is there to compensate them for this, but also, due to preferred habitat, you're going to have to convince or pay more for them to go outside of their comfort zone. And additionally, if you've got a longer term investor and want to convince them to borrow short term, you're going to have to reward them for that. Because longer term investors prefer certainty. They want to just invest and do nothing. If you make them invest over a short term, that means at the end of the short term, they'll have to do something else. They'll have to reinvest. And they maybe want to be compensated for that. I noted before that this kind of is in line with liquidity preference theory. However, it doesn't state that liquidity preference is uniform across the full time scale of the yield curve. And this is because within the different habitats, the investors have different characteristics, as I mentioned. They'll have different objectives, different time horizons. Therefore, if you want to compensate them for going above and beyond or below what they expect, then you have to adjust the interest rate you charge them. But remember, this is a very behavioural concept. It's about the behaviour of the investors here. And the last theory is what's known as market segmentation theory. And this actually contradicts the likes of expectation theory and liquidity preference theory. But it does hold quite in line with preferred habitat. Because market segmentation theory suggests that at different segments along the yield curve, there's different supply and demand. We could say in the different habitats, whether that be short term, medium term or long term, we said there's different characteristics under that theory. What market segmentation theory is suggesting is that there's different types of supply and demand at different segments along the yield curve. So if we think about a positive yield curve, upward sloping, and we break that into short term, medium, long term, then when economic conditions start to change, it starts moving from upward sloping to flat and humped. Well, this happens because supply and demand along the yield curve changes. If it's upward sloping, if we expect that interest rates might drop because there's some sort of economic shock going on, then the supply and demand at the longer term bonds is going to change a lot. Whenever there's economic nervousness, people might want to sell out debt, crystallize it, get cash. Therefore, the demand for longer term debt would drop as everyone tries to leave longer term and invest in short term. So if they leave longer term, then that will push down the end of the yield curve to more humped. And where do them demanders go? They go to the short term segment of the yield curve. So they potentially buy shorter term debt instead, which pushes up demand for shorter debt. So the left hand side of the yield curve starts rising as demand increases. So demand for longer dated bonds drop, the demand for shorter dated bonds go up. And I've only mentioned that example from a demand point of view, but that's also at the supply point of view. If you expect interest rates to drop, then if you're going to issue a bond, you're going to wait for interest rates to drop because you can issue the bond at a lower rate. So if the expectation is that interest rates are dropping, the likes of new bond issuance is not going to happen for a bit. and then when interest rates do drop, that's when they might issue the bond, and probably issue it for a longer term, because that's cheap debt for a longer period. And again, that would influence supply and demand at various different points of the yield curve. So if we just summarise these theories and whether they're actually driven by economics or by behaviour, we can see that the economic theory is more relevant to expectation theory, i.e. we did the maths, and liquidity preference theory. But we talked about market participants when we referred to the habitat theory. So each different theory has different assumptions, and this is what we need to be cautious on when we're looking at economics or behaviour. So expectation theory, very economical, rather mathematical. Liquidity preference, it assumes that a level of risk appetite is involved, so it is economic, but we assume some sort of risk appetite, the fact that investors are naturally risk averse. Market segmentation theory, again quite economical, but there's a behavioural element in there that in different segments along the yield curve, there's different risk appetites and very different economical supply and demands at different segments. So this theory really does contradict expectation theory and suggests that longer term bonds don't actually follow the path of short term bonds because they have very different supply and demand. And the supply and demand of long term debt can influence the supply and demand of short term bonds. And then lastly, preferred habitat again implies some sort of behaviour. It implies that investors have certain risk appetites and that to compensate them for going outside their habitat, you need to reward them for that. And then you'll have the risk-reward trade-off and the concept of investors' utility and what makes them more satisfied. So very behavioural. Following on from this lecture, I would like you to have a read of these theories and potentially understand them in the concept of economics compared to behaviour and behavioural finance. If you want to interpret this yield curve, is it forward-looking? Obviously, when the likes of financial institutions are pricing debt instruments, are they using the yield curve to do this? The derivatives market, are they using the yield curve to price future debt? Is this a risk management tool, or is it just an indicator? What are the downsides of this yield curve? Well, it's a very simplistic model. It's a very simplistic graph that's easy to interpret and easy to analyse. So it is certainly worth exploring the effectiveness of using the yield curve. And from a bank's point of view, we talked about, in expectation theory, the rollover of debt. Well, when banks have to finance their assets, we talked about their liabilities tend to be quite short-term customer deposits compared to assets which tend to be much longer. Mortgage debt, for instance. How do the likes of banks roll over short-term liabilities to fund long-term assets? Do they use the yield curve to set potential deposit rates in the future? How volatile are interest rates? How often does the likes of the base rate change? You probably think that's quite stable. It's only changed once every month, potentially in the UK. So that's quite stationary. But the likes of short-term interest rates change every day. LIBOR, which is the current indicator, is changed in midday every day. But this yield curve, how long does it take the yield curve to reflect all this information? But then when we look at the likes of issuing of debt, how volatile do interest rates differ across different institutions based on the levels of credit risk? As we know, interest rates are not that stationary. They do change over time according to maturities. We've looked at the various theories to suggest why interest rates at different time horizons may change depending on supply and demand. When we look at the volatility of interest rates, regulators obviously look at the downside, and so do shareholders. Ultimately, if interest rates change, to the bank, that will hit their profitability, but also it will hit the value of their assets, which we'll go on to explore when we talk about measurements. With bonds, we know that there's an inverse relationship between market rates and bond prices. If a bank is holding lots of assets, bonds, and if interest rates go up, bond prices go down, therefore that portfolio of assets shrinks in value. And if the asset side of the balance sheet shrinks, which you mentioned in part 1, then the liability side also has to shrink. And that's ownership equity shrinking. And we don't want ownership equity shrinking because that might impact regulatory capital. How is this all captured? Banks, as you know from your Banking Risk 1, they do value at risk calculations and extreme event scenarios on all their market risk components. You might have used the example of equities, but it's exactly the same when we look at the likes of products regarding interest rates. Interest rates, as I just mentioned, it impacts the price of assets. It also impacts income. If it's a variable product, interest rates drop. Therefore, the income you're going to receive is going to be lower than before interest rates dropped. So from an investor point of view, you need to understand the level of risk and the potential impact on your profitability. From a regulatory point of view, you need to understand how that impacts the likes of equity capital. And just to finish off this lecture, we're going to look at interest rate risk from a banking book point of view. And if you go to the BIS 2016, interest rate on the banking book is the document that you'll need to read to understand the measurement techniques and the required management techniques for interest rate risk. And there's some concepts that we'll go through in the next few weeks regarding refinancing risk, reinvestment risk, and market value. So we think about refinancing risk. This is the concept of getting additional liabilities to fund your assets. Reinvestment risk is when your assets end and you need to potentially raise new assets. Market value is all about how interest rate changes impacts the overall value of your assets. So we'll explore these concepts. As well as exploring these concepts, we also need to think about the various time horizons and the imbalance between time horizons. We've talked about banks and how their liabilities tend to be much shorter than their assets. Therefore, refinancing risk is typically the most one that banks face on their book. How do they get new liabilities to fund longer term assets? If we look at this very quickly on a diagram, this just shows you the potential risk you face when refinancing. The example here, you've got your liability at the top and the asset at the bottom. In year 1, you're paying 4% on a deposit and receiving 6% on a loan. So you're making 2% profit in the first year. But what if interest rates rise dramatically in the second year? Say if interest rates rise to 8% in the second year, then the bank will be paying 8% on that 10 million, but only receiving 6% on the loan. So therefore, you're making a 2% profit in the first year, but a 2% loss in the second year. So that's how refinancing risk can really hit your profitability. And on the flip side, reinvestment risk, exactly the same. You might have longer term deposits, longer term savings accounts, and on that, it's fixed rate at 4%. But you might be lending out over the short term and then issuing new assets year on year, potentially. And same rule would apply. If interest rates were to drop significantly in the second year, then the new loan you issue would be at a lower rate. And if that's lower than 4%, you'd be making a loss in the second year. So you can see in the first year we're making a nice 2% profit on net interest income, but the second year, what will happen if interest rates drop? Could hamper your profitability. When we look at the sources of interest rate from a bank point of view, the original definitions from the BIS in 2004 was the concept of repricing risk, yield curve risk, basis risk, and optionality. Repricing risk is really another way of talking about refinancing risk. You may have a longer term asset that you're funding on short term liabilities, and when you start rolling over this short term liability year on year on year to fund the longer term asset, repricing risk really happens when interest rates on the short out bond change dramatically, and potentially in the long term you might end up losing out. Or if you're potentially have a product that's one's fixed and it's funded by something floating, and if interest rates change and your funding costs start increasing above the fixed rate of your asset, then this is going to hamper you. So ultimately repricing impacts your kind of cash flow and your net present value of your cash flows and returns, and hampers profitability. Yield curve risk, quite simple. If the yield curve starts tilting and yield curve starts changing, then it's the shift of the yield curve and how that potentially impacts your profitability. And the yield curve doesn't shift gradually, it doesn't shift uniformly. Longer term interest rates could drop more and quicker than shorter term interest rates drop when the Bank of England base rate is changed. So it's about the shift in the yield curve, and potentially that one end of the yield curve might shift more than another end. Basis risk. Basis risk, if you remember basis risk from previous studies, it's all about short, very small increments in interest. And this happens where two products don't necessarily reflect the change in one another. So you might have two products that have very similar characteristics, such as a T-bill and a 3-month LIBOR product. So if you've got a 3-month T-bill and any other 3-month LIBOR product, if interest rates change, then there might be a small discrepancy in the changes in basis point of each of the products. So it's all about where two products have very similar characteristics, but there might be imperfect adjustments to the basis rate charged on them. And the last one is optionality. And this has got nothing to do with derivatives. So please don't make that mistake. Optionality is the concept of consumer choice. When a bank issues the likes of a mortgage, it can forecast the payment schedule over the full time horizon. But on a mortgage, the consumer has the choice to pay back early, to overpay. And this optionality potentially impacts predicted future cash flows. And this is also the same for deposit. You put your money in a customer savings account. If it's a term account, we assume that it's going to stay there. But if you withdraw it and take the penalty for withdrawing, that's still a consumer choice. On the flip side, there's also extension risk. What happens if you have a mortgage and you forecast as a bank the payment schedule, but then you may have customers that have a payment holiday, which actually extends the mortgage. We've seen during the COVID crisis in the UK that the government and banks came to an agreement to allow for wide-scale mortgage holidays without penalty. Then this has potentially extended people's mortgages for longer. So banks' asset books, maturity-wise, have extended it. You're probably thinking, okay, that's good for the bank, they've got an asset for a longer time now, but at the end of the day, it still disrupts their forecasting. They'll have to reforecast at the new extended dates. So that's what the sources, according to the regulators, was in 2004. But this has been updated, and as I said at the start of this part, in 2016 we have the interest rate in the banking book document, which I highly recommend you to go through and understand. It really converted it into three: optionality, basis, and gap. So what's gone there? Optionality still exists, basis still exists, but repricing and yield curve have really been combined to be gap risk. And if we look at this example here, what I've got down is there's different types of optionality. Basis risk, pretty much the same as before. In gap risk, I broke it down a bit further into kind of again a refinancing, but also yield curve is about the non-parallel shift in the yield curve. So within gap, you can see which part refers to repricing and which part refers to potential yield curve. But this table here is actually an example where we've tried to apply it to the likes of a bank and used evidence from the likes of Barclays on how this risk impacts a bank like Barclays. So when you need to discuss the potential sources of interest rate risk, do refer to 2004 document, but then demonstrate your knowledge of how the sources have changed to the new regulatory document of 2016. And this concludes the final part of this lecture. We have covered a lot of content in the last 3 parts. I'd highly recommend you to go back to understand the reasons why interest rates change. Look up the theories regarding Fisher's classical approach, loanable fund theory, and Keynes's liquidity preference, but then move on to look at the theoretical concepts of the term structure, to do some reading and mathematics regarding expectation theory, again recap liquidity preference theory, market segmentation, and preferred habitat. And all these elements are covered in this week's recommended reading, and in the Blackboard site we have a range of academic articles linked to interest rate risk within banks, so please make a start on this reading. In this week's seminar, as mentioned plenty of times in this part, we're going to look at potential predictability and forecasting ability of the yield curve. Thank you for watching.